Millions of dollars in retail capital are wiped out in seconds. This pattern is a targeted liquidity sweep, commonly known as a fakeout trap. It is a highly engineered mechanical event designed to extract capital from the unprepared. The core problem is one of misinterpretation. Retail traders see a sudden, violent price spike, breaking a known resistance level, and immediately assume a macro trend continuation is underway. Right now, we are reverse engineering the exact market maker logic, executing just above Bitcoin's $74,000 level. By mapping these exhaustion mechanics, we can pinpoint the specific drop zones required to survive the mandatory structural pullback hitting the market over the next 48 hours. Here at Crypto Whale Radar, we do not trade on hype. We trade on strict peer-to-peer institutional logic. Buying into the current retail euphoria is mathematically guaranteed to blow up your account by the end of the week. If you cannot identify exactly where a targeted liquidity sweep ends, you are actively volunteering to serve as blind exit liquidity for institutional players. Before we analyze a single crypto asset, we have to look at the macro engine currently dictating the entire market structure, the S&P 500. This is a one-month line chart of the S&P 500 on the 4-hour timeframe. Notice how the aggressive downward pullback of the last 2 weeks has strictly halted, forming a localized floor. This pause provides what we call exogenous liquidity. Exogenous liquidity refers to capital stability injected from an external market, in this case traditional equities, which acts as a strict prerequisite for any baseline stability in the crypto sector. But a localized bounce does not equal a confirmed macro reversal. Zooming out, the entire current price action remains perfectly encapsulated within a wider 3-month descending channel. The larger 1-month bearish structure places severe constraints on the broader market's upside potential. This overarching, delicate equity environment directly caps Bitcoin's immediate short-term price ceilings. Crypto cannot outrun the S&P 500's friction. Therefore, any bullish crypto thesis executed right now is dangerously tethered to this highly fragile short-term S&P 500 relief bounce. With that macro ceiling established, we can look directly at the precise mechanics behind Bitcoin's recent push above $74,000. This is a candlestick chart of Bitcoin showing the exact setup we mapped days ago. Market makers intentionally built a massive liquidity pool strictly between $70,000 and $71,000. Price was aggressively forced upwards with one distinct purpose: to trigger the layered short stops resting there and sweep the liquidity resting just above $74,000. This creates a highly specific technical state known as microstructure exhaustion. Microstructure exhaustion dictates that once the target liquidity resting above a major resistance level is completely consumed, the bullish engine instantly runs out of fuel. There is nothing left to drive the price higher. We can quantify this phase by looking at the 4-hour Relative Strength Index, or RSI. The RSI is a momentum oscillator that measures the speed and change of price movements. Right now, it is officially crossing into strict overbought territory. This marks the very first time the 4-hour RSI has reached this critical extreme limit since the first week of March. Looking back at that exact March setup, a liquidity sweep paired with a severely overbought RSI resulted directly in an immediate, localized downward price curve. Because of this required exhaustion, we project precise drop zones for the upcoming pullback. Initial support at $73,500, major support between $71,000 and $72,000, and a hard macro floor between $69,000 and $69,500. Initiating long positions on Bitcoin directly at $74,000 is mathematically flawed. The structural mechanics demand an immediate 1 to 2 day cool-off. Bitcoin's localized exhaustion does not happen in a vacuum. It actively dictates the structural setups across massive altcoin capitalizations, starting with Ethereum. This is Ethereum's price chart on the daily timeframe, highlighting a current attempt to break out of a brutal, multi-month sideways range held since early February. The strict upper boundary of this trap is a dense resistance block sitting squarely between $2,150 and $2,250. The immediate friction point is clear. Ethereum is colliding head-on with this resistance wall at the exact same moment its 4-hour RSI is screaming overbought. Even in a scenario where Ethereum confirms a strong daily candle close completely above the $2,250 mark, the mechanics require a retest. During the broader market cool-off, this previous $2,250 resistance ceiling must structurally flip to become a confirmed support zone. Executing trades precisely on these support flip setups is impossible if the exchange platform you use suffers from severe order slippage. To secure institutional-grade liquidity with zero slippage, use the BingX exchange integration link in the description below. Creating an account through that link unlocks exclusive mentor bonuses required for executing these specific setups. Having a perfect structural thesis is entirely useless if your platform mechanics fail you during these high-volatility market resets. To prove this exhaustion is a synchronized event and not isolated to Bitcoin and Ethereum, we expand our analytical lens to the broader altcoin sector. This XRP price chart confirms the exact technical bounce we outlined months ago, launching perfectly from our $1.30 to $1.40 macro support thesis. But right now, that upward momentum is aggressively colliding with heavy resistance zones locked at $1.54 to $1.57 and the strict $1.60 Fibonacci level. Bringing Solana into the framework, we observe it violently striking a massive resistance box spanning $95 to $105, despite reading as oversold on the longer 3-day timeframe. Looking closely at the immediate 4-hour timeframe, Solana's RSI is maxed out in overbought territory, perfectly mirroring the friction we just verified in Bitcoin and Ethereum. We add Chainlink to the analysis, charting its direct approach into the critical $9.5 to $10 psychological resistance wall. Breaking that $10 barrier opens a massive technical vacuum straight up to $11.5, but mechanically, the asset lacks the fuel to clear that wall without a short-term reset first. The data points are uniform. Bitcoin, Ethereum, XRP, Solana, and Chainlink are all simultaneously overextended against major resistance blocks. This state is defined as sector synchronization. Market makers utilize this unified exhaustion to execute highly correlated, sector-wide pullbacks, trapping late retail buyers across the entire board at exactly the same time. When the entire crypto board is synchronized at peak resistance, a 1 to 2 day structural reset is an absolute, unavoidable mathematical certainty. The data from today's analysis distills down into one non-negotiable trading rule. A completed liquidity sweep, combined with an overbought short-term RSI, guarantees a structural reset. Ignoring this law is the fastest way to become exit liquidity for institutional traders. Subscribe to the Crypto Whale Radar YouTube channel right now and use the link below to join our closed Telegram group. This channel is the only place providing rigorous, BS-free institutional market maker logic over retail hype. A final warning: do not attempt to blindly catch falling assets during this impending 1 to 2 day pullback without proper confirmation. Click the video on your screen immediately. I will walk you through the precise volume profile indicators required to safely buy the upcoming dip when the market resets.